Welcome back to today's Explainer. I'm super excited you're here because we are diving into something that is literally everywhere right now: artificial intelligence in the stock market. We hear the buzzwords every single day. But today, we're going way past the hype to see how AI is genuinely impacting financial markets. We'll look at the hardcore academic research all the way down to the actual tools you can use right there on your phone.
Okay, let's dive into this because this brings us to the core question we all want answered. Is AI actually replacing the human trader? Or is it just acting like a really, really sophisticated assistant? Let's separate the reality from the science fiction. Here's our roadmap for today. We're going to start with the academic science behind the AI trading revolution, examine the consumer screeners available right now, and then uncover the strict institutional rulebooks that govern actual trading before we finally tackle the risks.
Part 1. The AI Trading Revolution.
To figure out exactly where we are right now, we have to look at how AI is actually being deployed. Now, what's really interesting about this slide is that out of 50 recent academic studies on AI in finance, look at that massive dark blue section. A full 40% focus directly on algorithmic trading. So institutions aren't just using AI for things like fraud detection. They are pouring massive resources into predicting price movements and identifying market inefficiencies. Moving into part 2, behind the algorithms, let's quickly define the underlying engines powering this whole revolution. Before we get into the consumer platforms, what's actually under the hood? First up, we've got machine learning. Representing a staggering 50% of the AI algorithms in recent financial research, these are the absolute workhorses. Simply put, they analyze historical data to build predictive models, constantly hunting for patterns that traditional, old-school statistics might just completely miss. Next is deep learning. Think of these as incredibly advanced neural networks, processing massive, massive data sets for high-speed trading. But they come with a major catch. They often operate as an unexplainable black box, meaning they might predict a stock movement perfectly, but the model itself can't always explain why it made that choice. As you can imagine, that is a massive transparency headache for financial professionals. Finally, there's natural language processing, or NLP. This is the tool that powers market sentiment analysis. Imagine a system that can instantaneously read thousands of SEC filings, breaking news articles, and millions of social media posts, all to quantify the market's mood in real time. It basically takes all that unstructured text and turns it into a hard, measurable data point that algorithms can actually trade on. All right, Section 3, AI screeners in action. Let's transition from the academic science to the actual tools available to everyday retail traders today. So how does all that theory translate to you and me? Well, let this number sink in for a second. Over 8,000. That is roughly the number of stocks listed across the U.S. equity market. For a human being to manually scan even a tiny fraction of these for earnings catalysts or sudden momentum shifts, it's a practically impossible data problem. And that right there is exactly why AI screeners are becoming the new baseline. With traditional screeners, you're forced to set static manual parameters. But AI screeners, they add a predictive intelligence layer. They use dynamic filter logic. They pull in those NLP sentiment signals we just talked about, and they continuously recalibrate to whatever the current market is doing.
So, what does the consumer landscape actually look like today? Well, platforms range pretty widely. You've got Webull, which integrates its Vega AI directly into a commission-free brokerage to instantly translate dense financial earnings reports into actionable summaries. Then you have platforms like Trade Ideas. They cater more to active day traders with their Holly AI, which actually runs thousands of nightly simulations to deliver intraday signals, though that does come at a premium price. And just for contrast, tools like FinViz offer an excellent traditional rule-based baseline, but they just don't have that native machine learning predictive layer built in. Let's move to and see how this builds into Section 4, the hidden rulebooks. This is where we see the strict rules at proprietary trading firms that limit these powerful AI tools. Because look, having powerful AI tools is one thing, but actually being allowed to use them is an entirely different story. Almost every prop firm out there advertises that they allow automation, but check out this rule from a firm called 4Traders. Quote, "The EA may watch the market and tell you things. It may not decide." This perfectly illustrates the massive gap between a firm's marketing and what they actually permit. For a lot of these firms, your highly advanced AI is strictly limited to being a decision support tool. Fully autonomous trading is often quietly prohibited.
If you look across the industry, a very consistent band list emerges: high-frequency trading, latency arbitrage, tick scalping. Why are these banned? Well, prop firms operating on simulated capital essentially make money when traders fail. A lightning-fast AI algorithm extracting value from microsecond price discrepancies has a genuine structural execution edge over the firm's own pricing, so it simply gets banned.
Now, terms like toxic order flow can be pretty vague, so some firms police these AI speed limits with hard, measurable numbers. Take Blue Guardian's 2-minute rule. They automatically flag and penalize any trade closed in under 2 minutes as illegal tick scalping. This specific, measurable constraint immediately disqualifies a huge class of high-frequency models from even participating on their platform. And multi-account AI automation? That pretty much dies right here in the copy trading rules. If you build a great model, you obviously want to scale it. Prop firms generally allow you to replicate decisions across your own accounts, basically acting as the source or the master signal. However, identical fills downstream of someone else's model, like an external AI bot, are strictly banned. If your account is just copying inbound signals, you're going to get closed down. Oh, and remember those event-driven NLP models we mentioned that trade on macroeconomic releases? They face a complete calendar minefield. Firms like DNA Funded or Maven heavily restrict trading around major news. We're talking no opening orders allowed 5 minutes before a release and no closing orders for 5 minutes after. Some firms will actually tax your profits if your bot executes during this window, while others will just ban you entirely. Your event-driven AI is severely handcuffed here. Finally, Section 5, Risks and Hallucinations. Let's analyze the overarching dangers of leaning too heavily on automated intelligence. So the crucial point is, beyond the strict rulebooks, what is the real danger here? It's generative AI hallucination. Even the most advanced brokerages explicitly warn their users that AI agents can absolutely misinterpret instructions. They might act on delayed data or just perform poorly when market conditions suddenly shift. We have to remember that AI signals are research tools, not guarantees. Unchecked automation without human risk management is just a recipe for rapid, uncontrollable losses. And this brilliantly illustrates how those consumer hallucination risks tie right back into the academic concerns of algorithmic bias we talked about earlier. Recent research highlights that the black box nature of complex models is a persistent flaw. When these models lack accountability, whether you're a day trading retail investor or a massive Wall Street institution, that lack of interpretability is a major structural risk. Which leaves us pondering a pretty fascinating dynamic. AI stock screeners and predictive algorithms offer an undeniable edge when you're trying to parse a market of 8,000 stocks. Yet the institutions providing the capital are actively building higher and higher fences to keep the most powerful autonomous features at bay. So as these algorithms inevitably get faster and smarter, will the rulebooks adapt to embrace them? Or will the restrictions just get thicker? It is an arms race that is truly only just beginning. Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.